Welcome back to Passing Notes with Chaz Guinn. My name is Hayes Brumbeloe. I'm your host, and it is good to have you back in the studio. Let's go again. Episode 4.
We're on our way.
They're happening quickly.
They are. And they should be, right?
Yeah, it's fun. This is a fun conversation. Before we jump in there, I did just turn the heat on for the first time in the house. You know when you turn the heat on for the first time, you get that smell. You're like, oh, is the house on fire? So I had to bust out the old pumpkin spice.
It's time.
It's fall.
Fall weather.
I love fall in Texas.
We needed it. It's been too hot.
Spring and fall in Texas. It's magical time.
It's special.
I love it. I love it. However, what I don't love, and I'm going to go ahead and jump right in, is the current market conditions. So I wanted to kind of peel that onion back, and I always say, let's peel back the onion. We're going to peel back a lot. They're going to be like, what are you, a farmer? All you're doing is messing with produce. But let's talk about it. I mean, we're dealing with inflation, rising rates, and there's a wave of NPLs that are soon to crash ashore. And I think it's less than 12 months potentially. What are your thoughts?
I think a lot of folks right now are seeing consumer goods at the highest level in years, right? With inflation, cost of milk, cost of gas, etc. Right? Just to live your life is a lot more expensive today than it was just a year ago or even 2, right?
Agreed.
And so, we look at what's the potential turn of events that could cause the market to be even more, let's just say, frothier, or even far more product to come to the shores. And we say, look, there's still going to be a time frame before we see a heavy onslaught of real delinquency and real product.
You think it's a drip?
I think it's a drip.
Yeah.
I think that we're just south of the midterm elections coming up.
Yep.
We don't know what type of ramifications that will have on the market.
Correct.
And then what we do know though is it's currently bad for most across the country. In the USA, your traditional family that's been living that paycheck to paycheck, and now your consumer goods are at all-time highs, and now we're heading into holiday season, right? So what we are seeing though is it going to get worse than it is today? I think so. Yeah. And I think there's a lot of data that's kind of showing us why that's going to happen. But, we're talking about the future market, where we think the market's going to go. What about the market and the assets that were sitting in all of these sellers' portfolios over the last 5 years, heading into COVID? I mean, you've talked about this. How much delinquency was on balance sheets of mortgage lenders pre-COVID?
Right.
Okay, we were having this debate over the weekend where we talked about there was at least 800 billion, capital B, of delinquency pre-COVID.
Right.
And then we went into a famous term of forbearance agreements. And the government was handing out forbearances to 1 out of every 2 delinquent homeowners, right? And that was their stall tactic to kind of keep folks in their house, keep communities together through a repayment structure. And now we're seeing up to 45%, almost half, delinquency rate on the forbearance agreements given by the government. So that volume is already going to be added to the volume that was there pre-COVID. But so, yes, I think there's enough inventory for us to discuss and market conditions in terms of borrower conditions that still need to be addressed from the pre-COVID days, right? So I think me and you will get into where do I think the market's going, but I think where we are today it's tough for your traditional American family.
I agree with you 100%.
But I think it's going to get tougher.
Do you think it's a 2008 all over again, or do you think it's a needed correction?
A needed correction.
Yeah.
I think we're having a healthy debate about, why we know that this market is going to not be anywhere near what 08 was. I mean, the average delinquency across the country on balance sheets was 14% in 2008 through 2010. 14% of the market was delinquent, right? That's a hefty, almost 20% of the market. Today, we're sitting at 2% delinquency. It's a big gap.
That is
right?
A big gap, yeah.
Well, so where do I think it's going to go? Call it 5 to 6%. I think the delinquency rate is going to increase to. Today we're at 2. I think it goes to 5 to 6 over the next 12 months. That correction right there is needed. Hayes, how long have rates been artificially low?
Correct. Yeah.
Sub 3%, sub 4%. We talked last episode how almost half of the mortgages across the country have a rate under 4. And here we are going into a 7.25 up to a 7.5% 30-year fixed.
Right.
your ARMs, your 5-1 ARMs, your 7-1 ARMs are sitting at 6.5%. And keep in mind, after a period of time, they recast. What's that rate going to go up to? So it's a needed correction because we've seen values on an increase that we've never seen in the last 25 years.
That is correct.
HPA, home price appreciation, has been on a tear. Okay, so not only has appreciation been on a tear, but so have rates been artificially low. Don't you think that was in an unhealthy market?
Agreed. Yeah.
So now you're going into a 7+% 30-year fixed market. HPA is softening, and now we're saying, well, this correction's needed. We had artificially low market conditions over the last few years. We need to kind of get back to, I wouldn't say normal.
It was a seller's market.
Big time was it a seller's market. And now we're excited because this is a buyer's market. Yeah. And we can kind of get into that.
Yeah, let's go there. What does this correction mean for investors getting into the note buying space? I think it's a huge opportunity.
I think this is what we're trying to uncover.
Right.
You know, right? And bringing these podcasts to the market is saying, look, here's why we feel more than ever are you being able to get into a space and really be able to actively acquire real estate at hefty discounts to today's market value.
100%.
And we all know that there's going to be a valley that we're going to hit in terms of value declines. Sure. But then what happens when we start to scale again and get back to the mountaintop? Right. But you went ahead and bought a ton of real estate at a down valley market, right? So yeah, we're able to today just put aggressive offers on many portfolios, up to $50 million of asset value that we put offers in on. But our price points that we're offering are far lower than we've been just offering just 6 months ago, and we're getting entertained. So it's a buyer's market now. And
I think that's what this podcast serves to start really putting those nuggets out there. Because you have to start thinking about, how do I diversify in market conditions like we're in right now? You have to be thinking about things like this. You have to become aware of opportunities like buying notes, because at the end of the day, some people are they're buying real estate at 90 cents on the dollar and thinking it's a good deal. And it is if you don't know anything about notes.
Exactly.
Exactly. So it's like if you can get into anything right now in the current market at 90 cents on the dollar, and you don't know about notes, when you hear about notes for the first time, you're like, what?
What do you mean 50 cents on the dollar?
What do you mean? What do you mean 50 cents on the dollar?
So that's what I feel like we try to debunk that myth all the time. Is this too good to be true? Can you really acquire real estate for that cheap? Guys, what about a 3-bedroom, 2-bath house that's sitting vacant with nobody in it? Right. And it's in a nice, good neighborhood, right? That's a shell. So lenders across the country are locking, securing your shell just to make sure my asset protection is there, my asset value still remains. But we've seen the lending space, both in originations to regular mortgages and also lending in the bridge space, the bridge lending, fix and flip lending, right? Mm-hmm. You buy a house for $250,000, you put $100,000 into the house, and now your ARV or your after rehab value conditions is now like $450. You were being able to get a nice loan for that. Mm-hmm. So that lending arm we're starting to see is tipping, meaning lenders that gave you the loan for the bridge and now are in default. The guys that took the money and borrowed the money for the bridge loan can't pay it back, right? Because why? You're unable to sell the property in today's market. How many offers were we talking about where people were paying over the listing price? Oh. I mean, we did. Right. We got an exceptional offer on our property in California, well over list. Right. And we hadn't seen a market people paying that high over a list just to get into the space. Because everybody knew you were shuttered at home in 2020, 2021, mm-hmm. and your house became your workspace now.
Exactly.
So staying at home and having a home office, that became absolutely key. People were willing to overpay just to have that opportunity to get in.
100%.
Right? So 100%. We don't see those trends continuing. We're actually starting to see the days on market going higher.
Yeah, they are.
We're starting to see offers being accepted under the list price. Again, this is all tendencies to say why we believe this is a buyer's market and folks need to get in.
And that's part of the correction.
And it's needed.
Right.
Again, back to it's a needed correction.
Yeah, I love it. So it's a needed correction. It's not 2008. Obviously, we've had some offline conversations with other people in the industry. They consider it to be like a cousin to 2008. One even described it as a kissing cousin.
Isn't that what we... We said, look, no, it's not going to be '08, but it's going to definitely be a cousin, and you're going to know that they're related. Right?
Kissing cousin left me laughing, man.
So we said to ourselves, look, we're not going to see the delinquency rates get that high again.
Right.
I think the government will step in to kind of protect what that landslide of product.
And it's going to be a drip.
But it'll be a drip.
It'll be a drip.
And like I mentioned, if we went from a today's market around 2% up to a 5 to 6%, that market flow right there, that's 10+ million mortgages that could be dripped.
Yeah,
right? Exactly. That's enough product for
yeah.
most investors to get in and have a good deal flow for years.
Especially newcomers who are new to this space. That's enough to say, you know what? Let's dip the toe in. Let's go ahead. Just like the example you gave a couple of episodes back, the guy had a full strategy. Started with one, X amount of years later, he's sitting on 14,000 notes.
$6 billion.
That's crazy. That is crazy. Mm-hmm. But the thing is this is the time, and I think this is why this podcast is so unique and valuable, especially for newcomers who are discovering the note space. Because at the end of the day, this is a huge opportunity. I think a lot of people are going to jump on. A
few episodes ago, we were talking about infrastructure. I think I used that word a lot because what we realize is we've seen a lot of folks come into this space that have from an engineering background. They know how to rip through Excel. It's very comfortable for them. They also know how to project manage. They know how to set up systems. Right. They know how to use CRMs, right? Mm-hmm. They know how to follow up properly. They know how to have resources from Maine to San Diego, from Seattle to Tampa. Okay. So what we've seen is the ability for folks to say, look, I can own a national portfolio. I can get flow consistently. I can be able to buy residential real estate up to 40 to 50% discount to market. Really? Yeah. And it's all backed by first lien assets, all backed by residential real estate. Yeah. Show me what that looks like. Exactly. And that's why we're saying, look, in a correction that we know is coming, a needed correction that we know is coming, what we always say is in a down cyclical market, this business booms.
Right.
In a healthy market, this business does very well because there's always going to be a percentage of delinquency on the mortgage balance sheets across the country.
And that's an average about 2%?
2 to 4% is going to sit where an average healthy market is in terms of delinquency. Right? And in 2008, we saw 14% delinquency. Right. Do we think it's going to get back there? Of course not. No. Do we think it's going to get to around 6, potentially even 7% over the next 12 to 24 months? We do. Yeah. And we said last time that facts tell. And then stories sell. Well, the facts are showing T&Is are up. We're showing consumer goods are up. We're showing layoffs are up.
T&I is a big part of it.
That's a big deal. I mean, that is what, from a look at certain parts of the year in California, I'm not sure if you know this, at this time of the year, fires start to break out. Between November through January, it's fire season. Odd in the winter, right? Well, what about your insurance premiums that are constantly skyrocketing? Because you have to have that sort of protection layer as a homeowner, right? But now you're heading into the fire season. Look what just happened in Florida. We just left the hurricane season, right? Now, there's certain parts of the market that are going to be far colder than other parts of the market.
Sure.
What happens in winterization? What happens in properties that are sitting vacant, that the pipes are freezing, and now you have to completely gut that because you didn't have the right T&I in place. Right. So this is why the corrections needed, Hayes. The folks paying over $100,000, $200,000 over list price, that's not a healthy, sustainable market.
No way.
Appreciation up to 20 to 25% annually, that's not sustainable. 50% in a 2-year span people were making on appreciation. Yeah. Right? So we know we need to get back to normalization.
It was a seller's market, and there was a lot of people who took advantage.
Look, we did, right?
Yeah.
So look, I'm not immune from being able to take advantage of opportunity, right? And that's why we left California and wanted to come to this beautiful state of Texas, where we feel like this is literally the business mecca, right? We know what New York brings, we know what Chicago brings, but I think Dallas, Texas has something to say about that.
Yeah.
And what we wanted to do from a firm is be in the middle of the country, right? We wanted to be in a tax-friendly state.
100%.
We wanted to be around good human beings, but we also wanted to be able to travel and get there in a relatively faster time frame.
Agreed.
Every time I was traveling the East Coast, I'm getting hit with a 5-hour flight, 3-hour time difference.
Right.
Kids that want to talk on FaceTime the beginning of the morning, right? So it's time that we start unlocking the information that we know that we're kind of keeping close to the vest and bringing that to market to say there's education here we're trying to teach, but there's also flow and relationships we're trying to build that will really be able to take advantage of this down cyclical market we know we're going to experience over the next 1 to 3 years.
I think it's perfect. That's what this podcast is all about. That is all the time we have for this episode. It goes by quick. It goes by quick. But thank you for joining us. Make sure you like, share, copy the links, share it with your friends. I mean, like we've said before, I mean, we're just trying to get the word out, you know what I mean? And so, you know, share it with your family, your friends, everybody, and let's start the conversation. Make sure you post your comments, your questions. We'll then roll those into future episodes where we dive a little deeper in some of those questions. But thank you again. Make sure you go to revolve-capital.com. Link up with us. We'd love to meet you. We'd love to work with you. But again, thank you for stopping by, and we'll see you soon. Cheers.